Good afternoon. I'm Mike Ryan from M&T Bank. And today's session will be managing third-party vendors in the new regulatory world. Bob DeGennaro will be our presenter. Bob's a senior operations and risk executive with 30 years of experience in the consumer and finance BPO services, mainly in mortgage banking, card and retail services, and commercial installment loans. As director of the U.S. practice at Bridgeforce, he currently manages the large U.S. engagements and provides strategic leadership and guidance in achieving project successes. Bob's background includes executive positions at J.P. Morgan Chase, GE Capital, Citibank, and Household. He brings expertise building quality control systems to achieve regulatory requirements, championing global offshore outsourcing collection strategies, starting a BPO servicing company, implementing successful operational programs, and building and nurturing partnerships. So please join me in welcoming Bob to the stage.
Thank you, Mike. It's good seeing you again. It's been too long.
I know.
Good afternoon, everyone. How are you? Excellent, excellent. Well, before we get started, I just wanted to cover a couple of housekeeping items. The first one I know is very dear to everyone is that we have cocktails that are going to occur about 5 o'clock, and I'm going to do my best to get you out of here even before that so you get a nice front row seat, right? So that's the least I can do after going through vendor management presentation. And the second one, and this is really important too, I'm going to be reversing the roles here, and I'm going to be asking you questions about some of the things that I'm going to present today. So if you're a little bit not sure about something, or you don't think you really are up on your vendor management questions, you might want to just move right now to someone who's really got their act together on that. So just so that you know. Well, thank you very much, and it's good to be here. Today's topics we're going to go through, basically we're going to discuss the increase in regulatory expectation on third-party management. As you all know, it's continuing to get heightened with a lot of the new regulations that are coming out. We're also going to talk about future industry implications and how to turn risk into reward and opportunity. First thing that I want to do is give you a little idea about why I joined Bridgeforce. First, the most important thing was I joined about 3 years ago, and I found that the culture really aligned closely with a lot of my own personal experiences. And that's basically to make sure that we do what's right for our clients. And in addition to that, I've also found that we share a lot of common practices in the industry. We have a very deep focus in compliance management, default management, and a lot of other areas within the regulatory and compliance area. And again, the most important part of it was the fact that we help our clients become successful by growing their capabilities and really addressing their executional risk. What you're going to see here are a couple of guidance that's come out from the CFPB and the OCC. It's clear that you're going to be held responsible as a company if, in fact, there's legal violations occur. In addition to that, the OCC came out in October 2013 and said that the use of third parties does not diminish the responsibility of its board of directors and its senior management team. And that's critical to understand because not only are companies now going to be held responsible, but also individuals who are making the decisions. You can really tell that the regulators mean business, so you should take this to heart. As you can see, here's some samples of some of the guidance that's come out, some of the enforcement actions. Over $30 billion, that's huge, that's a big number, has been affected through the third-party oversight and robo-signing practices that we've seen. And it's still growing. Very important that you understand that this is going to continue to be part of the regulatory world of understanding what your risks are. Third-party vendor management expectation is simply this. the relationship with your customer belongs with the institution. And even when you decide to outsource that to a third party, and these are just some examples that are on the right-hand side, you can expect that that same level of expectation is going to continue. It's all about the customer experience. I can't stress that enough. If you handle a customer the way you want to internally, you got to do the same thing externally. You can't make a difference between managing your operation both internally and externally. It has to be one. So, are you ready? Everybody ready for the ride? I don't know, right? Be prepared. Get your parachutes out. It's going to be a fun ride. So, let's get started. The first thing that you have to make sure when you're starting to look at your vendors that you have on board is you just ask the first question. Do you really need them? Right? I mean, that's the first one you want to do. And then if you do need them, what are you going to do to make sure that they stay compliant? They make sure that they put your customers first, and that performance now is on the bottom of the ring, right? It's no longer about performance as much as it is making sure that we stay compliant. Once you determine what that list is, and you evaluate that, you must want to continue to look to see if there's consolidation opportunities. You want to look at the fact that are there anyone here that doesn't have, a low value add that we could possibly consolidate. And then once you have that final list that you put together, you now have to develop a robust process to manage that. And that's what I'm going to talk to you about now. At Bridgeforce, we've developed a model that we've actually implemented with several major large institutions. And really the focus has always been to provide something that's useful, that allows our clients to be able to continue to operate in this space. We don't want you to walk away from this discussion today and say, well, should I be using vendors? No, actually the answer is you should use vendors, but use them the right way. And this model will help out quite a bit. So before I get going and I start talking about the components of the model, does anyone have any idea of what would be a component of such a model? Any hands up? What would you do first? Yes, sir. Yeah, absolutely. Audit would be one part of it. Any other ideas? Any other thoughts? Now, Dave, I see you out there, a colleague of mine at Bridgeforce. Dave, would you like to help me out here? Risk assessment. Yeah, that's always a good place to start. So why don't we go there? So here's the four components. Risk assessment, the actual due diligence, your contract structuring, and your oversight, your monitoring oversight. When it comes to risk assessment, the first thing you have to do is identify the key risks within your organization or the functions that you want to consider to outsource. In some cases, you would identify that as high, medium, or low as potential categories, but it depends upon your own guidelines within your company. Once you've determined that, we've developed a process that we'll score them and we'll weight them out and we'll determine whether or not, do they fit right with the processes that you have in place. And then we share that with a steering committee. And one of the things I'm going to talk about later is the actual components of a steering committee and how important is that. I'm going to ask you another question right now. How many of you are on a steering committee today? Okay. So are you on one, or are you on two, or are you on several? Because what I'm hearing, there's a lot of steering committees out there that everybody participates in. Two. Can I ask what the names of those are?
Bank of America, so we have a vendor steering committee where we have those four components and a few others. And we use that to determine how we're going to deal with those vendors. Are they following our contract? Do they follow the laws, rules, and regs? What are our on-site abilities looking like? Do they follow that?
Exactly. Policies and procedures, both compliance risk, reputational risk, all that gets kind of included. Excellent. Thank you for that. So yes, so that's the role of the steering committee is very critical, because as you decide what those key processes are within your organization that you're going to consider for outsourcing, and really I think you got to take a hard look at this and say to yourself, the relationship that I have with that vendor, is that something that I need? And we addressed that earlier, but not only do I need that, but how do I make sure that they're maintaining their level of attention to my accounts with both in that operational risk perspective, that compliance risk, and of course the customer experience. The due diligence process. A lot of you do have that today. When you onboard a vendor, can I ask, show of hands, everyone does a pretty robust due diligence process? As you could determine, that's very comprehensive. And it looks at everything from the financial health of a particular vendor to the organization of that vendor to whether or not, how do they handle the customer experience, the complaints that come in, whether the source of the complaints, how quickly do they respond to complaints, are they really keeping track of the root cause analysis that goes with it. There's a lot that goes into that process that you need to consider. And in addition to that, what you want to make sure is that once you have determined the types of risks that are associated and the types of functions that are out with those agencies that you may have or whatever the vendor relationship might be, you then can really look at it and start thinking about, well, what are the correlations that are affected by that? And so the due diligence process is very important. It's comprehensive. It really deals with a lot of different variables. And then what we do is we also come up with a score and a questionnaire that asks all the various different questions. We ask agencies or whatever your vendor is to respond to it. And then based on that, we come back with either a pass or a fail score. The contract structuring. It's very critical that you have a consistent contract across all your vendor relationships. That has to be there, and it has to include everything that you can think of from a policies, procedures, from your operational risk, from your compliance risk. Again, always taking the customer into consideration and making sure that you have your SLAs in place so that the expectations that you have with your vendors are clearly understood and that they know what's expected as a result of your contract. The rights to do audits, right? How frequently you do those audits, the indemnifications, the liabilities, all those things go into your contract. And it's very important that you're detailed and that you can really drive those with hard metrics. The last piece is the oversight, and this is very, very important because even once you onboard your particular vendor, you have to make sure you have a very robust process to monitor it and to evaluate the types of metrics that you put into that guideline. So in instance here, we talk about a few things like account reconciliations. We also look at the SLAs. We monitor those very closely. And so this is a very important part of the Bridgeforce model. And it's one thing that you've really got to pay attention to because things can happen very quickly. You have to monitor them based on your risk. So one thing would be like if you have a high risk type of function, let's say like a legal collections type of function, you might want to say, I want to review those things more frequently than maybe a low risk like a letter type of vendor. So we recommend that the specialized default management vendor control needs to be closely integrated with your corporate vendor process today. How many of you have a corporate vendor program? Yeah, great. Well, as you can tell, based on what I've already told you about the operational need to really dig down and really focus in on some of these key performance indicators, you really need to have the specialized approach to help you manage your process. And that's why this particular model works well with your vendor program. But you're going to have some tough conversations. I've got to tell you, I've got some battle scars from going in and talking to various different groups about their vendor program when you talk to the vendor management team versus the operations team. And there's a whole set of different guidelines that go with it. So, you've got to be prepared to make the tough call, and you've got to be prepared to really sell, your program. Steering committee. I talked to that before and the importance of the steering committee. Now, you've said that many of you already have steering committees in place. And what is really important about the steering committee is that it has to be a group of people both internally and externally to your organization. So you have that level of independence that you can have a frequent discussion with and make sure that those final decision points are being decided on, and you have a group that's there that meets regularly. And it's not just about the onboarding piece, but it's about the existing program as well. So it's both operationally, as well as new vendors, as well as existing vendors, policies. All that goes to the steering committee. And they document that. And why that's important, because when a regulator comes in, they're going to look at all these documents and determine, well, once you've gone through and you went through the vetting process, and let's say you pass some particular vendors and some might have failed, it's important that that documentation is stored so that they can have quick access to it. So it's a very important part of the process. I would tell you, if you don't have a steering committee today, you should get one. And I can also tell you that your corporate audit team has to remain independent of that. That independence of having your corporate audit team versus the operational team is really crucial as you start really developing your different types of practices. So what does this mean? From a certification process, I mean, really the bottom caption takes it all. Vendors must be managed as an extension of your internal operations, as customer harm is viewed differently in the eyes of the regulators. I can't tell you enough how important that is. And so when you look at this, you have to make sure that if you're going to go down this path, just make sure that you have this type of program in place. And really, the certification process is very important. The annual certification allows you to go back in and take a look and say, what's changed over the last year? The regulations change. You want to make sure you're up on all regulations that are out there, all laws that are pertinent to that particular activity. You might want to think about your strategy, and this is a good time to reevaluate your strategy and say whether or not do you want to remain within that particular vendor group or vendor process. So it's a combination of really looking at many opportunities, and that's why the certification part of it's so important to the success. This is not a one-and-done process. It has to be part of your internal operation, and it has to be part of really the mainstream of your program. Also important is the QC process that also exists with your vendors. Some of the better vendors have a process internally that can work with yours. And this allows a good interaction and make sure that you're reviewing the same types of reports, metrics. At the end of the day, it really helps to have that level of support between both your internal QC process and, of course, the process that exists with the vendor. So what does this all mean? I have a chance now to bring up Kurt Klein, who's part of our sister company, the Bridgeforce Law, and Kurt's going to take you through this slide on contracts.
Yeah, thanks, Bob. Unmute. My name is Kurt Klein, managing partner of Bridgeforce Law. Bob had asked me in this regulatory environment on a tactical level, what are you seeing different in contracts? So obviously, to the extent that we're reviewing a portfolio sale or a portfolio services agreement, that's going to be different than a core processing agreement. But there's some commonalities, and the CFPB has ostensibly stated that the agreement from 2 years ago is not going to pass muster for the agreement today. That you have to take these off the shelves, knock the dust off, and update your agreement. So there are some commonalities, though, that I'm seeing. One, brought in indemnification rights. Two, decrease limitations of liability, enhance and expansive SLAs, a heightened level of covenant detail. I mean, this is one of the really big points, one of the differentiators. I mean, we're seeing agreements now that used to be 2 or 3 pages that are now 22 pages and chock full of SCRA and auto dialing requirements. That level of detail was never in agreements before. Increased data security, system security. Broadened termination, immediate termination rights, particularly for the financial services companies, and increased audit rights, as Bob, you had mentioned previously.
Great. Thank you, Kurt.
Sure.
So you can see the importance of making sure that you're staying up. I would say that, how often do you see this change, Kurt? Would you say, like, if you saw this like a year ago, that some of these things would be
Yeah, so
different?
it's been a ramping process. Certainly, I'd say starting 18 months ago, we started to see dramatic difference, but it's been a cliff. So it went from 2 pages to 5 to 8. I mean, it went from 2 to 20, significant change.
Right. How many of you today have something similar in your contracts that relate to this? Excellent. How often do you think, for those that raise your hand, how often do you change your contracts to revise them? Do you do it once a year? Do you do it sooner than that? And is it consistent between a vendor type within your organization? That's very good. It's critical to stay on top of that. So what does this mean now to the financial institutions? So this is where you have to take a hard look at yourself in the mirror and say whether or not you want to continue to have the relationships you have with your vendors. And if you do, we're not saying that you don't need to drop vendors, but what you need to make sure is that you have a program in place that can adequately manage and monitor them, as we mentioned earlier. So it's a must-have to have this type of third-party vendor strategy within your operation if you're going to continue to have a collection strategy that includes vendors. The cost of overseeing and enforcing vendor relationships is dramatically increasing. I think you've all seen that. I mean, as you continue to go through and you continue the compliance-related activities occur, you've got to add costs to your operation. The financial institutions realize that the cost benefits of those controls and are outsourced back in-house. And what we're saying there basically is, look, if you have a high-risk process today and you have the capability to bring that process back in to your operation, you should consider that. And of course, we expect to see continued consolidation in this space. I think all of you who have had relationships with vendors, let's say over the last 5 years in particular, would you say that the number of you that have those relationships, have you seen consolidations within your space? By showing your hand. Yep. Would you say it's more than 50%? Yes. And so that just shows you that, again, and part of that too is I think that as you start identifying vendors that have these types of controls in place and that really are part of your program and it really fits well with your strategy of your company, then I think that's where you get the best synergies. So turning risk into opportunities. First thing is, as we talked about, is the consolidation of vendors. You would expect that should continue to happen with oversight reducing and regulatory risk occurring. The idea here is if you consolidate, you also minimize your risk, right? At the end of the day, that's really the game. So again, look at your vendors, make sure that you understand who they are, and then consolidate them, makes sense. Evaluate and redesign the outsourcing strategy to align to your new environment. Again, if the opportunity exists and you can bring in high-risk vendors, makes sense to do that. If you find that you have a specialty vendor, again, the opportunity there is to, work with that vendor and see whether or not there's an opportunity to continue to enhance their performance and manage them closely. But at the end of the day, I think you have to make that decision on your own. It's risk and reward based. And then where it makes sense, the automation, if you can do that, that takes out some of the risk because you have a consistent process that occurs. And I think that's where the opportunities exist today, is where automation can improve both the customer experience, taking consideration all of the regulatory regulations, and more importantly, I think it allows you to feel that the capabilities and the reduction of errors are easily managed and documented. Yes, sir.
Well, just as it relates to the consolidation of the vendors.
Right.
Totally agree. And you think we have to be sensitive and careful to
as well, because if we're going to hold them to the SLAs, and if they're not meeting them, you're going to have to react to that.
Right.
So you're now going to have to maybe terminate a vendor, but you need to make sure that you have an opportunity for another vendor to maybe take that.
Yeah, I mean,
place so
it's a great point. I mean, you've got to make sure that, you know, what some clients that I've seen have already started vetting through a process where they may have 2 or 3 vendors already in the wing. I think some of you have done that within your own businesses. And so this way, if you have that situation where you have to make that call and terminate that relationship, you know, based on what a consequence matrix that you might have in your organization, you know, and let me just talk about a consequence matrix for a second. You know, that's something that's critical to the process of determining whether or not you're going to terminate someone, is having a level of thresholds and triggers in place that really determine at what point do you want to either reduce volume, stop placements altogether, if it particularly be an agency, or terminate. So it's always good to have 2 or 3 particular vendors already vetted through your process in case you have that situation occur. Very good question, though. Thank you. Did you have a question, sir? Okay. In fact, that's good leadway because it's time for questions. So look at that, huh? That worked out pretty good. So, yes, sir.
On the legal implications slide,
Yes.
there was a point there that said that,
Want me to go back to it?
yeah, you could go back
Sure.
to it. There was a point that said there was a decreased limit of liability clause, and I would think it would have increased limit of liability. I sort of wanted to get your thoughts or explanation of why it's decreasing as a result of these regs.
And it's a great question. It's an increased level of liability, a decrease in the breadth of things covered by that limitation. So, for example, we're seeing carve-outs from that limitation. You're seeing the carve-outs of the limitation for where it used to be you'd have an indemnification provision, and then it would just say you're going to comply with all applicable laws, and then we're going to indemnify you for any violation of those laws. You're now seeing expansive carve-outs to that limitation.
Other questions? Yes.
Hi. Question on the, can you go back to the beginning in your framework on kind of the centralized oversight? What are you seeing across the industry? Are you seeing this enterprise vendor management playing that second line role of monitoring, testing, or is that being undertaken by compliance as a function?
That's another good question. And in fact, Brian, do you want to address that one? We have Brian Reese here, who is our president of Bridgeforce. Yeah.
I think it really depends on your compliance management structure and your control framework, but second line of defense can be corporate vendor management if that's the role they're playing. It also can be your standard compliance team that does second line of defense for that particular business function. Again, because you're talking about there is a standard corporate vendor management process, but we need much more specialized capabilities. That corporate vendor management group may not have the knowledge and expertise to do credible challenge. So again, you'll have to be in that area.
And in particular, as it relates to the CFPB and customer-facing vendors, you at risk, I'm looking at this model as well, whether it makes sense to have compliance play more of a role as a subject matter expert in that area, given the CFPB expectations over and above the OCC.
Well, I mean, you bring a good question, and obviously compliance has to work closely with this process. What we found is that, I'm sure you're familiar with the 3 lines of defense, and usually in the first line of defense, there's a couple of tiers, I'll call it. You have your first line is your business line control piece, and that's part of this, equation is have that first line business line control, and then you also have the second piece could be, your quality control process as well. So you have the check-to-checker process as in there as well. So I think when you think about it that way, it allows at least the business to have a chance to start to think about, well, at least let it start with a business line activity. But then that's why you have the steering committee, because the steering committee allows both internal and external participation to occur. So any level of escalation that occurs, you do get that input of compliance is a part of that committee, legal is part of that committee. So you have a good cross-section across the organization. So there is some input to that process. And certainly, I think you have to be comfortable with it within your own business. And that should be a business strategy, determination. But we've seen it with a business line control functionality.
Question in back. So this is a little different question. The gray hair gives it away, but I've been at this for a while, and our environment's changing so rapidly. I talk to so many cohorts across the industry that they frankly don't know if they're where they should be. So I guess my question a little differently is, what does Bridgeforce have available to the industry in terms of an autopsy or an analysis? So, someone can come to you and say, hey, how do you look at my situation and say, oh yeah, you're pretty good, or oh man, let's have a cup of coffee. Right?
I'm gonna ask my colleague here, Dave LaRoche, to answer that question.
So good question, Larry. So our program is a program. I want to stress that it's not a series of scorecards. It's policies, procedures, it's contract templates, it's the various scorecards that Bob mentioned. So one of the things that we do, and is a very frequent exercise for us, is we will come in and assess someone's vendor management program and basically do a gap analysis to our program. So we will point out where you're strong, where you have sufficient expertise and controls in place, and we will also come in and identify where opportunities exist and where there's the opportunity to build out further controls. So it's something we do very regularly, and we have quite a few individuals within the organization who have run projects like that, including Bob, myself, and some others.
Yeah, great. Thank you, Dave, for that. So there's a couple of applications that we could do. When we usually come in, we do an assessment, and we determine whether or not the program you have in place, does it meet all of those regulations. We go through a checklist and we determine what's best as far as maybe enhancements. In some cases, it could even be a rewrite of your existing program. And so it depends upon where you are in that process and what really needs to be evaluated. But again, that's a great question. And anytime you need to have that kind of independent view or another set of eyes to look at your function internally, it's always great to bring in someone like us who have that level of experience. Other questions? Yes, sir.
Vendors of vendors, are you advocating that lenders through the due diligence process collect due diligence documentation on a vendor's vendors? So sub-vendor, if you will.
Yes. Yeah, so you're talking about like fourth party, right? In a sense, right? And so that's another issue that you run into. So you have third parties who can bleed over to fourth party, right? And so you've got to be conscious of that. And so that's why you have to put in some level of audits that are requirements that says that, let me see and let me verify and let me understand how are you holding your third party or your fourth party relationships accountable. And they should have that same level of due diligence. And if they don't, you should fail them.
Thank you.
Other questions? But, we got a lot of time for drinks, right now. I'm telling you, this is a good time. Matt, did you have a question, Matt, or do you want to make a statement? Matt Scarborough, our CEO, is here.
So I think one question there to talk through a little bit is, you've talked thematically, Bob, about some of the things that have changed, but about the change in the expectation of the level of evidence, right? Just a couple weeks ago, having a conversation with a client and talking through the difference between, well, I ask a vendor, do you have X policy, and it was a yes or no question, versus, okay, did you get a copy of that policy? Did you get a copy of the reporting to evidence that, a copy of the corrective actions that went out of that report? I think walking through some of how take these themes and what's that mean in terms of my level of evidence standards and how we've seen that evolve.
Well, it's a great question. I think that, you're going to continue to see that as you start driving more into your processes, you're going to start seeing that there's a level of need to really start thinking about how do you stay in front of this? I guess some of your question is how do you stay in front of it, right? The evidence-only review, yeah. That's a good question. I'm going to ask Bo Backerman to weigh in here and give some feedback. He's one of our colleagues, too, from Bridgeforce.
Yeah, that was fun. Was there a question? No, I'm just kidding. So, the approach of getting down to this evidence-only review is little akin to, I was having this conversation a little earlier today with a fine member of the CFPB around this notion of, it's no longer about kind of burden of proof, hey, examiners, show me what I did wrong. It's now about, I can show you what I have in place to prevent things from going wrong, and taking a view of ownership around that burden of proof such that when you get down into the detail, whether it's at the individual regulatory citation requirement as it applies to a vendor, that you have proof of what's happening and that you are appropriately vetting any type of documentation that's provided to you so that you understand the source of whatever that information is, because you can't take the report quite at face value when you're necessarily dealing with a third party, or as we were just discussing in the case of fourth party, you've now got a vendor who's contracted with a contractor to them. They may be providing information to your vendor that then flows back to you. How do you know that that information that's coming from the fourth party is coming from the right data source and has all of the validation behind it? So what it comes down to is kind of this, artifact-only type proof where you have also done some validation of the artifacts. Related to this, and I won't wax poetic too much because I already see some of my colleagues saying, oh no, we gave Bo the microphone. But you asked for it, Bob.
Sure was.
One of the interesting things about the vendor management environment is if you take your classic 3 lines of defense framework with, risk assessment, prevention, detection, correction, and then kind of the governance over that, that whole model applies to third party. And when you start to look at it that way, some of the times what we see, the wonderful question that was asked down the aisle here around, well, where does second line come into play and so forth, we often see opportunities to make more robust one or more of the lines of defense as it relates to third party. Most of your contracts, if not all of them, probably have auditing rights. How often are you really, using those rights so that you have now the third line? Actually, it's usually when there's a problem and lawyers are involved and, hey, we have the right to come in and audit. But if you take that 3 line of defense approach and say, let's pretend like it's ours, even though we know we have to call the vendor, say, do we really have 3 lines of defense in place with all of the components, risk assessment, prevention, detection, correction? And you'll typically find that either horizontally, kind of with the lines of defense, that there may be some weakness, or within one of the disciplines of those lines of defense. I hope that answers the question. Thanks for putting me on the spot, Bob.
Hey, anytime, Bo. And by the way, you cut into my drinking time, so, you gotta stop that. But it's a great response, and I think really the key there is documentation and having really good, strong documentation and being able to reference that as needed. I think that's so important. As you all know, there's a lot of room to improve when it comes to documenting and storing it and making sure that it's available when needed for any type of review. And the important thing is understanding and not repeating the same potential issue again. Yes, sir.
Do you have any smaller models for the really small community banks who, for example, may do 5 foreclosures a year may put out 3 vehicles for repo a year, and they may have a sole practitioner attorney that does their foreclosures, and they may have one repo agency that does their repossessions, you know, and rather than creating a contract, they just turn over the foreclosures to this same lawyer that they've been using for the last 30 years.
Yeah.
Same way with the repo agency.
Yeah, no, I mean, so the answer to that is you need to have the same type of rigor. Even if it's small volume or low volume, it's still higher risk, and it's still, you know, important to your institution or your business. But however, you know, as we would come in here and do the due diligence, we could make some recommendations on how maybe to modify the program that we have in, but still keep the components and still keep the rigor, but how to modify it based on your unique types of business. And Brian, did you want to add something to that?
And I think this is a really important question because there's been a lot of talk about materiality. And materiality is, well, is it a low dollar? Is it a small transaction level? I think you have to go back and think about, we have such small volumes, does it make sense for us to outsource? Can we just bring those functions in-house and staff that? So those are the decision points that you have to make, or you have to be prepared to do something. But you can modify some of these things so it's not as intensive as this.
Correct.
Agreed. Yeah,
Right.
agreed.
You know,
But
sure.
he was talking about foreclosure. Yeah, you don't want to send your internal people out to do those types of matters. And agreed, there are certain things that you cannot bring back in-house. But if you're having someone involved in a process like foreclosure, you're going to want to make sure that they're doing all the right steps. That you're overseeing them, especially in a legal environment. So it's a really good question. Thank you.
Yes, sir.
So I'm in probably the back row surrounded by vendors. So I'll volunteer to speak for the vendor corner. All of us have been audited. All of us are used to 20-page contracts. All of us have the necessary training programs in place that emphasizes FDCPA and SCRA. We all scrub our portfolios. We all do it diligently. So everything that Bridgeforce told you, I would like to think that your vendors are already doing. Everybody from our cleaning crew, who's a vendor, we absolutely vent because we have to. So I'd like to think that everything you heard today, most of your vendors are already doing. I would think if you just reach out to them, they are willing to share with you everything, although obviously you need the checklists and everything else the Bridgeport people talk to you about. If you're not sure of something, ask one of your current vendors what they have. Why reinvent the wheel? We share a lot of information with some of our clients who are starting this process just because we've been through it so many times. So don't be afraid to ask your vendors for their expertise. They've been through it a lot. And no offense to the Bridgeport guys, they're not going to charge you nearly as much. So that's my comment.
Well, I mean,
we are eligible. We have not had a CFPB exam. However, we are a large participant. We feel like if the CFPB walked in our shop tomorrow, Larry, we'd be prepared for that. We have spent years preparing for CFPB. Our clients have been examined by the CFPB.
Watch what you ask for.
That's
all I'll tell you.
But it's going to happen,
right?
If you're a large participant, it's going to happen. You better be prepared for it. As our clients download that information back to us, we feel like we're prepared. Are we perfect? No.
Well, I mean, you bring up a good point, and I think that, you know, obviously, you know, one of the things is have good communication and good understanding of what your third-party vendors have, right? I mean, that's always important. But I think you also have to challenge them on making sure that they have everything that's needed, right, to get the job done. And that's where I think having an independent kind of view to do a health check. I mean, think of it like a health check. It can't hurt to have an independent view come in and just do a health check and make sure that all the right processes, all the right procedures, the way you evaluate, you know, your vendor's performance.
I'm not saying Bridgeport's not.
No, I'm not saying, no.
I just wanted to make sure that the audience knew that I think most vendors really try very hard to position ourselves to keep our clients out of trouble.
I would tell you that, yes, there is a lot of vendors out there that have good controls in place and have done a great deal of work to get there. But they've also been pushed by a lot of the institutions that are here too to make sure they are compliant. And they also have to reinvent themselves. One of the things I think it's very critical that everyone needs to understand is that if your vendors want to stay in this environment the way it is today, and it's not going to change, you know, they're going to have to reinvent themselves and get on the program, or they need to get out. It's that simple. You're either in and you understand the regs and you abide by them, or you get out. No in between. The in-betweens will get you in trouble. I guarantee you that. Right. Absolutely.
The cost of compliance are substantial. Some vendors can't afford it.
Agreed.
So I totally agree with you.
Yep.
You know, there's one other point, and I think I've met with a lot of vendors in this space too, to hear their perspectives. And one thing that we advise our clients to do is also look at the way you compensate and work with your vendors. In the past, you might have been focused on performance and to make sure that they're running and gunning on performance, but you actually also want to look and really revise the way you look at the contracts and the process and say, are these people providing and doing the right thing from a compliance experience perspective? And that should drive the level of compensation that they achieve. So I think as an industry, we have to look at our agreements, not only from a legal perspective, but from how do we compensate our vendors to make those investments and keep them whole, and make sure we're rewarding the right vendors that are doing the right thing. Because I agree with you, there are a lot of vendors doing the right thing and making those investments, and they should be rewarded. So, thank you.
I mean, Brian brings up a good point. Those of you who have vendors today, do you have like anything in there for compliance knockouts? Like if there's a compliant issue that comes out, do you penalize them? Even if they might be your top performer, if you're an agency or a law firm? If they don't follow their compliance rules, you do that? Do other people do that as well? I mean, are you putting compliance and customer experience first? Because if you're not, that could put you in trouble. If it's only going to be performance, don't do it. Make sure that you're focusing on compliance and the customer experience, because those are the two things that matter. From the talks that I've seen so far today at this great event, and whenever I hear and whenever I stop and I listen to regulators, it's always about the customer experience. If you don't get that now, you're going to be in trouble. So you got to make sure that that customer experience is there and a big part of your equation. Any other questions? I got to thank you. This is great. I mean, I thought the conversations and the questions were outstanding. I really appreciate everybody's focus on this particular area. It's very critical, and I'm glad that a lot of you already have a lot of these programs in place. So congratulations on that. Look forward to working with you closely, and have a great time here today. See you at the bar.